So let's talk about some easy ways that you can plan a trade. What could help us plan a trade? No, I would say account size is typically irrelevant to planning the trade. And Brian, um, research some stuff on the company is a great answer. Take a look at the fundamentals. Are they a company that actually stands a chance? And the technical aspect, the charts. When it comes to charts, we have specific things called support and resistance, right? There's many different ways that we can find support and resistance, but as far as I'm concerned, you shouldn't look for many ways to obtain it. Let me give you an example of a chart. If your charts look like this, you will typically find more ways not to trade than to trade. You don't need every indicator they make to make a trade. I plan my trades off of charts like this. You see all my indicators? Do you guys want my indicator values? Everybody always wants to know my indicator values. So when it comes to a trade, I look at several different things. Well, you're right. Volume is an indicator. You are right. The volume, even though it's an actual value, a real value, it can be well used as an indicator in itself. For me, I look at several things when planning a trade. We'll take this first solar chart, for instance. I could look at things like resistance points based on closes to develop a candle pattern strategy for the trade. I could use trend lines to devise channels for the trade. I could use Fibonacci, which is Fibonacci trading systems, my #1 trading system. But what should I never use? All of them. I should never use all of them. Why? Well, let's look at things. If I was using swing points for my trade, I would be ignoring points where Fibonacci's told me to enter. If I was using channels, I would be ignoring entry points If I entered off of Fibonacci, I might be hesitant and then wait, no crap, and then wait, no crap, I find more reasons not to trade it than to trade it. Yeah, I am 100% a Fibonacci trader. I do channel trades on longer term things, but I am 100% a Fibonacci trader. That doesn't mean I don't know how to trade other trade systems. In fact, I know them quite well. I actually have different accounts that I trade each account with different trading systems. That way, as I go back and evaluate, I can find which one's more successful. When I come across a channel trade, I use my channel trading account. When I come across a Fibonacci trade, I use that account. And for me personally, I'm most comfortable with Fibonacci trading. I will say, Aaron, that it gets me in the most trades and manages my risk very well. To the point I'm happy with it. But when we talk about support, that's what? What is support? I like Kim's answer. A point we don't want to let it fall below, right? And if it were to fall below that point, what do we do? Apparently, Brian, those answers above yours sound like that's the strategy. If it fails a support point, the support point, whatever it may be that you have in your trade plan, then your trade plan has failed. If your plan has failed, what should you do? Exit and replan, right? You know, if you're in love with the stock, but it fails that I'll let it go this far down, but not any farther down, you know, that's a good way to plan your trade, because it's where are you willing to let it fall to when your money's in it? How much are you willing to lose? But when it gets to that point, should you alter how much you were willing to lose just because you're unable to make a decision? Absolutely not. That very reason is why I use what on nearly all my common stock trades. Yeah, stop order. If I don't already have it in my plan to use an option strategy for that stock, then I may have it in my plan to have a point at which I'll stop at. So if I have it in my plan, here's where I'm buying, here's all the farther I'm willing to let it fall, why not put a stop order in? Why not put a stop order in? Does anybody have a good reason not to put a stop order in? Yeah, you like pain and stress. You like to lose more than you were willing to lose when you entered the trade. If it goes below where you were going to stop out, you don't want it anyway. Or else you wouldn't have planned that as your stop out point. Right? Let's think about that. It doesn't matter if it comes back. You could buy it again. When I play common stock, my stops are based on support points. Let's say I wanted to buy First Solar, okay? FSLR, the chart that you see on your screen. I would have to identify that this low is my current support. That's the low that led to the higher high. Okay? I would probably modify it slightly and say if it falls below the last high close, or if it closes below that, I'm going to stop out of half my position. But really, this stock is in no danger whatsoever unless it falls below here. Now, that's almost a $10 fall, isn't it? Let's look at that. It's currently at 56.84, and your low here, 47.04. Okay? What percentage is that? Well, 56.84 minus 47.04. And if I were buying right here, that'd be the difference. Divide that by 90 or 56.84 again, multiply by 100. It's a 17% possible loss. Do you think I'm actually willing to take a 17% loss on a full position? Heck no. Not when you're putting as many dollars into a common share position as I do. 17% be lots of money. I'm pretty comfortable with 5%. How could I make this 17% loss turn into a 5% loss? Or not loss, but risk. My position size. Well, Brian, I'm just saying, assuming that for some reason I believe that I needed to buy it now because it's going much higher. And I at least want to get my foot in it. I want to get my feet wet. I mean, I just go in small. When do I add? The only time I would add on one like this was when it pulls back and makes a higher low. Let's assume this one did pull back and make a higher low. I would want to be able to move this line up somewhere, right? Because if it pulls back, makes a higher low, the higher low is not truly confirmed until what happens? A higher high is made. But once a higher high is made, you've got a new stop point. So as my stop out point moves higher, what can I say about my risk? Gets lower, right? Which allows me to then put more money into it. If you trade your common stock trades in relation to where the bottom is, as opposed to the price you may be buying it at, you'll find yourself a lot more successful in your trading. Because if the bottoms get higher, your risk is lessened, and the price that stops you out gets higher, while still allowing you to continue to newer highs. Makes it quite easy. What stops us from doing that? What stops us from trading properly? Ignorance and fear. Emotions, yeah. Lack of patience. I'd rather sell a winner to go put it into a loser. That's the I need tax write-offs category of people. They need tax write-offs so bad that they're willing to sell a good stock to go buy a crappy one. Never quite understood that philosophy, but it's a very, very common one. Usually amongst people that only last about 3 months in other chat rooms. And that's only because their memberships are 3 months long. So playing common stock trades in relation to where the bottom is, not necessarily where you're buying it at, and managing your risk according to that bottom, allows you to do what? It allows you to stay in a trade without the fear of getting shaken out if you've managed your risk prior to making the trade, right? Anybody here ever make a trade and then try to plan for it later? Okay, I'm in. Let's figure out what we're going to do. Yeah, ready, fire, aim. I like that one. I like that one, Michael. The fact of the matter is, most of the time when you buy a stock, if it's a quality stock, and you've taken the time to do some research on it, to give you the conviction of wanting to buy that stock. And I'm not talking about long-term investments, several years. I'm even talking about individual swing trades, swing trades trying to catch a single swing, a single move up or down. But it's okay if by the time you're comfortable buying it, it's not at the bottom, isn't it? Is it okay to buy it here instead of here? Well, don't worry. I'll teach you all that, and most of the time I do it for you. And the point I'm making is it's okay to buy a stock that you've spent the time researching and you're confident in its ability at any price, so long as you've done what? Manage the risk through your position size, right? Regularly averaged down in stock trades or options trades. You ever hear that term, averaging down? What's the success rate been when you average down? Averaging down, and that's a very, very good question, Ryan, is when you're in a trade and it falls, so you figure rather than selling it because it failed your plan, you should just buy some more. Then maybe it falls sometimes, some more, and well, you want to average your price down again by buying it lower than what your current average is, so it brings your average down. What I found is more times than not, it makes you lose a smaller percentage. Because when you bring your average down, you're going to lose a smaller percentage based on the average you held. But it typically means you're going to lose more money. So if you want to feel good and say, well, I only lost 30% instead of 80%, that's great. I'd rather say, hey, I lost 80%, but it was like $500, as opposed to I lost 30%, but it was $1,900. Has anybody ever heard of averaging up? Averaging up, I love it. Averaging up is buying a little when it might be more dangerous, buying more even if the price is higher, but when you're safely in the trade. It's the proper way to scale into a trade. When you do it that way, what's your most dangerous buy? The first one. Let's look at that. With INSY, I bought it $12. It goes up. It hits like 1950. It pulls back to like 1560. I buy again at about 1750. Buying again with the exact same amount of money. It wasn't the exact same amount of shares, same amount of money. But let's say it was a share for share thing. Would my average be 1750? Will it be what I actually bought at the second time? Or do I have to average in that cost I bought lower? So is it safe to say that by the second time I buy, I can probably get out safely before I lose money? In this case, it would have been like $14, $14.50. I'd had like $3 to say whether I still liked it or not. And if I wanted to make a third buy, maybe in this area or over in here or over in here, even though that buy might be really high, is my average going to be all the way up there? Well, cash, had it not been a focus group trade, we would have. But remember, with the focus group, we are doing small amounts, single buy, single sell, right? Keeping things as basic as possible. Now, somebody could say that, okay, I can see all in, good and well that type of strategy, but you're still telling me you bought it at the end of June, and even though you got a big gain, you did this rocky road of up and down really until mid-October. That's not what I'm looking for. How could you apply the same type of strategies but not trade such a long term? No, it wouldn't matter if it was options or common stock. Let me ask you this. Could I use the same strategies with a chart like this? Maybe I think I'm buying the low here, but I don't know if it's the low. So I just buy with a little bit. And then as I see a consolidation pattern happening, I mark it on my chart here. And when we go breaking out above it, I buy some more, right? Making my support the lower end of the consolidation. Where would my average be? Well, somewhere halfway between down here where I bought and right here where I bought, right? So we'll say something like that would be my average. This becomes the stop. I could simply shorten the term on the chart and apply the same rules. Do I want to do it with a chart like this? A 1 minute chart? I think they should get rid of 1 minute charts. This is the worst chart ever created. Why? Well, let's face what a 1 minute chart will do. Whether you're using indicators or maybe like a Fibonacci system, anything really, just trading off of candle patterns alone, a 1 minute chart is typically, probably 80 to 90% of the time, going to give you buy and sell signals based on a 1 to 2.5% move. Are you trading enough money to make good income on a 2.5% move at the max? 1% on the average. So why would you use a 1 minute chart? 3 minutes is going to give you on average about 1.8% to about 4% for proper buy and sell signals, whether you're using indicators or anything else. Are you trading enough money to make good profit off of that? I don't see any reason why anybody here would be using less than a 15-minute chart. Well, it'd be hard to imagine that you wouldn't notice severe changes like that on other charts too. But if you put together, and I'll pull up my records. I'll search for those tonight when we're done with chart testing I did on all these terms of charts with indicators, without indicators, over 1,000 charts that can prove it to you. Because I don't teach anything until I've actually tested it. The point I'm making in the planning is you need to know what you're willing to lose. And you need to then establish how you'll implement your money into the trade. And a simple way to decide on that, we'll go back to like this First Solar chart. Let's imagine First Solar was back down here at this trend line, at that bottom. Would you want to buy it if it hit that line and bounced off of it? Would that make you want to buy that stock? Yeah, if it didn't fail support, if it didn't create a lower low. So why would you want to sell it anytime before that point just because it may go down a little bit? Anybody have a good answer for that? Like an actual logical answer? Yep, changing fundamentals, things like that. But the point I'm making, your broker would love for you to just sell it and then buy it again if it hit your line. And then sell it again and buy it again if it hit your line, right? Why would your broker like you to do that? Yeah, that's how they make their money. Anybody ever find themselves looking at the same charts over and over again? Like, well, I had a win on it, or somebody I know had a win on that chart, so I'm going to watch it. You ever do that? Yeah. So if you know you're going to do that, why not trade it properly even if it is slightly longer term? Somebody give me one that you guys have been trading over and over and over again. Common stock. Doesn't matter what it is. Go to PHOT, one of the pot stocks. Okay. Let's look at something. I can only talk about the 0.032 because that's where I bought it. But I want you to look at something here. Might have been a reason to sell it here. Why would there have been a reason to sell it here? Right here. Why might there have been a reason to sell it there? Yeah, lower high, right? Bounce, came up, turn around. You see that evening star? Might have been time to go. So I could see selling it there, for sure. But let's look up until that point. Was there ever reason to sell PHOT if you got it anywhere lower than this line right here? Ever a reason? Now let's look at my favorite penny stock. We'll just go with the alerts I made since we launched the chat room. Where was there reason to sell? Oh, I'm not knocking them at all. Not knocking the penny stocks at all. If you saw, I was just showing a different way to trade. That's a lower high, isn't it? Lower high right here? What did I do right in this period, right here? What did I do? What did I tell you guys to do before I did anything? Yeah. Oh yeah, I sold a ton. I was one share from having to file a Form 4 up here. One share. It's the only reason I stopped buying when I was running it up. Intech, NTEK. I started buying this at 0006, November 2012. Well, we came up here, we pulled back. On the next day, we gapped up, but we were unable to make a new high. Confirmation of a lower of the pullback starting. And there's another reason I knew it was time to sell Intech. Anybody know what that was? Because every time I've said sell it, you better sell it because it's going to drop pretty fast. And every time I say buy it, it goes up. If you actually want a stock to go up, should you bid sit or should you buy the ask? Buy the ask. And when you want out of it, should you try to get an unreachable ask price Or slap that freaking bid so that you're confident going, hey, I sold higher than it's going to be because I crashed the bid and it's going low. Yeah. When I go to get out, man, I hit that bid so stinking fast, it's not funny. So everybody's been wondering, Coach, when are you going to alert Intech again? Somebody tell me why I would alert Intech. Let's look at it. When they don't, Brian, they lose on their alerts. Let's look at something. I got a high here. I got a high here. So far, it's looking like I might have a high here. When would I have alerted it? Well, it did have a low here and a low here. And I would have looked to alert it if it would have made a higher high and on the next low. Does any stock just go straight up without a red candle? Nope. Unless it's a pump and dump. A quality stock doesn't just go straight up, straight down, and sideways forever. A quality stock does not have a chart that looks like this, like TDEY. Quality stock doesn't look like BMSN, where it ran up during a pump and dump, came down, and it's gone sideways ever since. I'm all out of this one, personally, on hemp. But for good reason. And, for me, just there are several different ways to even look at a chart like this. If you got in at the proper time, you really have no danger until that trend line's failed. If you have a habit of buying at the high and hoping it don't go no lower, then it can be a little bit different. But developing simple reasons to keep you in a trade rather than to get you out of a trade can actually result in a lot higher profit potential for you. And it doesn't matter if it's a penny stock, if it's a big board stock, if you're trading options or not. Developing a strategy that'll keep you in the trade rather than getting you out of the trade. And let's face it. Let's say you would have sold up here. Let's say you sold at 8 cents. And when it pulled back here, you never got back in. At the time, it looked like you made a good sell, but did you? No. Do I make those mistakes? Let's go to ARTX. Bought it down here, sold that gap up, bought it down here, sold, bought, sold, bought, slipped a little bit, sold. Darn baby was born and I missed the buy. Was this sell a good sell? We were within 3 cents of that high when I alerted the sell. Was it a good sell? Absolutely not. It was a horrible sell. It's a horrible sell because, why? Something out of my control made it so I couldn't buy it again when I wanted to. And in all reality, it was in no danger until it fell below that low. You see, if I would have traded it properly, and this is me admitting a mistake, if I'd have traded it properly, I'd have been in it for that with a stop order entered down here. And then after my daughter was born, I could have said, ooh, hey, here's a low that resulted in a higher high. And I'd have moved my stop order up. And then when it pulled back for a week over here, I'd have said, there's a low that resulted in a higher high. And again over here, and yeah, I wouldn't have got the high. I'd have been stopped out right here. Which stop out would have been better? Here or where I sold? More times than not, a higher low will have a higher high. So I ask myself this every time I look at this chart. Why did I ever sell? I could have known because I know the proper way to trade. I just didn't do it. I had too many long-term positions at the time, so I was using a short-term trading strategy on this one. And if you're trading quality stocks, you know more about them than just what their current price is when you enter them. Who here runs scanners or screeners to help them pick stocks to trade? I can tell you who doesn't. This guy. I don't trade any stock I haven't researched. I won't trade any stock I haven't researched. I don't care what the potential might be on it. Why? Because when I implemented that into my own trading, wow, all of a sudden my success rate of winning trades went up. So now it doesn't matter. It doesn't matter where some stock I've never heard of might go. Doesn't matter. Yep. I typically buy, if I'm in common shares, I typically buy puts leading into their earnings, which makes me literally forfeit the profit I would make on that earnings jump. But I'm not in a long-term trade for a one-day jump. You know, if the earnings are good and it gaps up, I lose on my puts. Whatever I lost on my puts, I made back on my common shares. I sell the puts, life goes on. But if it misses and it gaps down, hey. I've got a right to sell at a price higher than what it is. So it's a risk. It's a way of trading into earnings on my long-term positions that I will always be willing to do. The point I'm making with stuff like this is, let's look at the move. Let's look at the move I gave up. I bought this at $1.75. I sold it at $2.29. What kind of move did I give up even had I sold it here? It's about $3.10. Well, $3.10 minus the $1.75 I paid for it, divided by $1.75, equals that, multiply it by 100, 77%. 77%. How long would it have taken? Well, from the 1st of November till mid-January, into January. So what, 2.5 months? Did your account go up 77% between November and the second week of January? If the answer is no, then don't tell me this type of trading is not something you could do. You understand what I mean? If your account is performing at a lesser rate than stocks you may have bought and sold already, but didn't trade them properly, but you just didn't want to hold for a long time, and that was the answer, then it's time to reevaluate the way you're trading. There is a difference when you approach a trade. In a trade that you might make money on, in a trade you have a higher probability of making money on. There's a huge difference. As far as the technicals go, as far as the chart goes, what is something we could look at very easily to see if we have a higher probability of making money on it? What's a very easy thing we could look at to determine our probability of having a winning trade? I'm going to give you a hint. It's not the free pump and dump newsletter you signed up for on a Google search telling you Jesus is the CEO and they found gold in the basement. What can I do just looking at the chart to determine if I have a higher probability of making a winning trade? How about just the trend? There you go, Mickey. If I'm looking for a long position, I want to see higher highs and higher lows, right? And if I'm looking for a short position, I would want to see what? Lower highs and lower lows. The trend of the chart will instantly increase the probability of you having a profitable trade so long as you trade in accordance with the trend of the chart. Does that mean you'll buy the lowest price? Or get the highest sell? Nope. But so long as the trend continues, and on quality stocks it typically does until there's a fundamental change, you've all of a sudden given yourself a higher probability of having a winning trade. One of the things you can do to have a very low probability of producing a winning trade is what? Trading something that you just haven't looked at, you don't know anything about, you have no clue what the risk is in it. You know, let's face it, on ARTX, personally, well, let's just say over here. Because right now, I don't know that I'd necessarily be willing to buy it right here. But over here, had I got that buy-in when my daughter was born and I couldn't, understanding that this low led to a higher high, regardless of what the chart did, you can go through thousands of charts and find that your probability is higher in doing this. If I would have bought at this point saying, you know what, it could go down to here, but I'll be willing to hold it for that, I might not be willing to lose a certain amount of money, so I'll buy less. But on an uptrending chart making higher highs and higher lows, you go through, you'll find the probability to be in your favor to trade it in that way. Because more times than not, you won't stop out. Although, hey, I might have bought that here. And yeah, it went lower for a few days. I could have got it at cheaper prices. But in reality to the trade, would it have mattered at all if I bought that thing anywhere between here and here? Would that have mattered at all if I bought in this area right here for what the trade produced? Exactly. There's a reason statistics prove 90% of day traders are broke within a year. That short-term mentality has them in and out, and in and out, and in and out, or just in and oh crap. You know, the day trader's idea of a swing trade is, well, I'm losing and I hope it comes back. That mentality limits your potential in a trade. And what is generally the cause of that mentality? Impatience. I can't tell you how many people I talk to that every chance they get, the comment of I can't hold a trade that long comes out. And I'm going to tell you that if you look back at what it could have been and ask yourself the question, plain and simple, did your portfolio improve at the same rate that stock did? If the answer is no, then not only could you have held it that long, but you should have, right?